Hi, good morning, and welcome. So first to the stage, Raul Martin-Ruiz, Ysios Capital. We have Samuel Levy from Lauxera Capital. Owen Willis, founder and general partner of Opal Ventures, and Zhang, founder and managing partner of Fusion Fund. So thank you for joining us, and I think for the panel here, I'll probably ask you all to introduce yourselves properly. Lou, would you like to start?
Oh, yeah, happy to. Good morning, everyone. So very glad to get together here in Barcelona, a very beautiful city, for the panel and also conference. I'm Lou. I'm the founder and managing partner of Fusion Fund. We're a VC firm based in Silicon Valley, Palo Alto, mainly focused on earlier stage healthcare, enterprise AI, and industry automation investment. So I started the firm back in 2015. Till now, we have 3 flagship fund under management for early stage, 2 opportunity fund, and invest across United States and with 82 portfolio companies. And also myself, I was an entrepreneur turned investor. I built and sold my own medical device company to Boston Scientific before I so-called went to the dark side to start my VC firm. So looking forward to the panel discussion today.
Amazing. Hey everyone, I'm Owen Willis. I'm the founder and general partner of Opal Ventures. It's great to see everyone here this morning, and looks like some people didn't go to the beach party last night, so that's great. So my fund is a pre-seed health tech fund. We're based in New York, and we're backing founders that are building out of lived experience in health tech, med tech, and medical devices. In terms of the kind of the fundraise and raising the fund itself, I actually raised the fund during what I think someone would describe as this down cycle, and so I'm happy to share some insights and lessons learned from that. My background is as an operator, so I built a medical education startup called Osmosis, which was acquired by Elsevier, and my kind of big contribution there was driving our B2B go-to-market, which ended up being something that has been really helpful for the founders that I've worked with. I also built and ran a health tech community called On Deck Health for earliest stage health tech founders. And a long time ago, I started my career as a special education teacher in Washington, D.C.
Hi, everyone. My name is Samuel Levy. I think there's a sort of recurring trend here that I'm also a medtech entrepreneur turned investor. So I guess I started off as a physician. With a classmate in medical school, I invented a medical device, which I built a company around called Allurion Technologies, which we just took public on the New York Stock Exchange about 2 months ago. 4 years ago, I founded an investment firm called Lauxera Capital Partners, and we raised a $300 million first-time team, first-time fund focused on health technology. I'm not sure whether we raised it during a good time or a bad time. Our first closing was during a lockdown. Our second closing was during a COVID lockdown. At the time, it felt hard, but I'm not sure whether the environment was better or worse then than it is now. But I'm delighted to be here and be on this panel.
Good morning, everybody. My name is Raul Martin-Ruiz. I'm a partner with Ysios Capital. Joined the firm in 2008. That was the year when the firm started. We are now managing plus 400 million euros across 3 funds. We are the largest life sciences venture capital firm in Spain, but we are investing globally, primarily in Europe and the US. Before joining the firm, I worked in business development and commercial operations in pharma. So I'm originally a pharma guy, and before that, I was an academic researcher.
Thank you. And I think clear that the panel here all have significant experience fundraising in a mixture of different environments. And I'd like to ask the panel, and Raul, perhaps you could start, looking back at the fundraising that you've gone through, what was the greatest contributing factor for your success in raising a fund?
Yeah, I mean, I think that there were several reasons, right? If we look at the first fund, that was in 2008, it was not a great year, I would say, for fundraising, as it happens now as well. But probably at that time, we had a completely new value proposition. So we were a first-time fund, first-time team, that's true. But we were planning to raise what at that time was going to be the largest venture capital fund in life sciences in Spain, and also with the idea of not investing only in Spain, but investing globally, right? That was there from the very beginning. So at that time, that was a completely different approach to what other peers were doing. I thought that's what helped us to raise the fund. Also, the fact that the team was coming from different origins, but all of them with a relevant background in terms of bringing value to a venture capital firm.
Samuel?
Well, I think I would like to say that it was like the fantastic nature of our team and strategy. I think we are like a mix of operators and investors, and we do a lot of thematic sourcing and are open to doing both minority and majority deals. So I think we had a positioning that's a little bit different than some of our peer funds. But I think the reality of it being basically a free money environment, especially compared to where interest rates are today, certainly helped everyone in the asset class attracting interest. So I think it was a mix of macro, which felt scary when we all went into a lockdown in our vacation homes. But then I think what ended up being a tailwind as people realized how broken the healthcare system is in the context of COVID. And then I think again it's raising a first-time team, first-time fund is like raising money for an early-stage medtech company. It's an uphill battle. I think we did something like 800 meetings to be able to raise our fund over 2 years. So it wasn't like Rome wasn't built in a day. It was just a long, bloody slugfest.
Brilliant. Owen?
Yeah, I mean, I think there have been a couple of factors. So for me, number one, this fund wouldn't have been possible from an outside perspective without the generosity of my network. I mean, I think a big part of fundraising is about the relationships that you have and the warm introductions, because that is the thing that enables you to build those relationships with LPs a little bit more quickly. And so I'm incredibly grateful for, obviously my friends, but also the founders and operators and other LPs that I've gotten to work with. I think the other kind of small factors were, number one, I chose to raise at a time when actually not a lot of other people were raising. And, I think on the outside, it might have looked a little bit foolish to be raising in such a bad environment, but at the same time, LPs have to put capital into funds, right? And I was the person who was there, who was raising, who was showing up, who had the confidence to say, even in this market, I want to be building a fund. And so I think that was a contributing factor. And then the other thing, building on what Sam was saying, resilience, right? You take a ton of meetings, you get a lot of no's, and as long as you are learning from those no's and making adjustments and iterating on your pitch, those no's can be incredibly beneficial. It's just about being able to push your way through all of those to find the people that you want to partner with.
Yeah, that's all very good opinion, which I also agree. And I want to add on to that for another kind of angle for most emerging managers is how to institutionalize the LP base. I also started Fund 1, 2 with majority of the LP or family offices. In Fund 3, we're able to convert 40% of the new LP as institutional LP. And institutional LP essentially are critical for a fund be sustainable and also grow to a certain size. But on the other side, they really are watching and follow with the fund manager probably for 3 or 5 years before they make the first commitment. And during this process, one thing critical is show that we deliver what we promise, have a very consistent methodology, and also based on the methodology, define the sector we're focusing on, how we allocate capital, how we build up community. And while in every 3-5 years, there's so many buzzwords out there, why we choose not to follow the buzzword and show that our methodology actually help us allocate capital in the right place. I think all of this consistency also give confidence to the institutional LP who are looking for long-term partner, be able to commit to our Fund 3 and start partnership with us. I think another thing we have to talk about, especially in the past 2 years, things are changing dramatically because of the performance of public market and the step back to the expectation of the performance of the private sector. So I think LP cares more about DPI now compared with a couple of years ago, especially for early stage VC. Sometimes a little bit challenging because early stage means we invest in a company, pre-seed that we're looking for 7-10 years later, and they will generate amazing billion-dollar IPO. But on the other side, if they saw some early DPI, no matter from merger acquisition or from other exit, doesn't mean they will push you to exit early, but they just want to have some confidence in the process, knowing there's a liquidity go along together with the fund and also prepare the fund for the potential for return of return with a couple, top performing company with billion-dollar capital. So there's so many things are rapidly changing based on market momentum, and even today we're expecting the performance of Instacart IPO, and ARM did very well last year. So I think all this performance on the IPO market are gonna also impact on the expectation from the LP coming back to the private sector investor.
With when you were fundraising through your process, how targeted was your selection of LPs and the reality of taking money where you can get it versus actually really pinpointing the people that you wanted, and perhaps maybe that's changed also with the different funds that you've taken on?
I can go first. So I think for me, the qualification of LPs has been incredibly important. So I brought in kind of some of the methodologies I used when doing enterprise sales, and that actually was incredibly helpful just from looking at my funnel of potential LPs and understanding who are the people who are really going to be excited about what I'm building. Because at the end of the day, there are so many reasons why an LP would choose to put your money with you versus another fund, but it boils down to, do they like the space that you're building in? Do they think there's a lot of money to be made? And do they trust you to make good decisions with their capital, right? And I think as much as I possibly tried within the raise, I wanted to make sure that they understood healthcare, right? And really were excited about healthcare, that they understood there was money to be made in healthcare. They knew what it took to build a company from 0 to 1 in healthcare, right? They understood the power of network in that early stage of building. And then, at the end of the day, I also wanted them to be people that I wanted to work with, right? This is a 10-year plus relationship. And so there was a little bit of qualification on my end of, is this somebody I can see myself working with over the next 10, 15, 20 years? And then, there's what that's meant, though, is that my LP base for the fund is almost all healthcare people, which has ended up being a huge value add to the founders that I work with, right? Because these are people who are, later on in their career, they have access, and building and selling in healthcare is really all about who you know and understanding the incentives that drive decision-making within the space. And it just so happens that my LP base is made up of people who know those things and know the right people. I would like to say that was intentional, but it was just it's kind of how it sorted itself out as I was going through the process.
Have you had similar experiences, and particularly around the selection of the LPs?
In our case, it was a little bit different. Back in 2008, when we raised our first fund, the reality is that we didn't have access to many LPs that were familiar with the sector. So we were going to invest with that fund in life sciences in general, or focusing on biotech, medtech, and diagnostics. And unfortunately, the number of LPs that had a knowledge on that space was negligible, right? So we obviously had to sell the merits of investing in life sciences to people that were not familiar with it. But as I said at the beginning, we put on the table a value proposition that was completely new for them, right? And they learned with us. So the investors of the Fund 1, we were, of course, in close contact with them quite often, and they learned a lot about the sector from us. So it was us educating them, and several of them, they decided to repeat in subsequent funds, right? So it was probably a different situation because most of our LPs, well, in the case of the first fund, I think all the LPs were Spanish, right? So we were not targeting at that time, being a first-time team, first-time fund, didn't make any sense to target international LPs that could invest in other firms in their countries, right? And they had been doing that in the past. So we decided to focus on the Spanish ones, educate them, and that was successful in our case.
So we have an LP who's a private equity investor who has a long history raising funds, and he told me, in raising funds, I have one rule: if the champagne is being passed, take a glass. And that sort of stuck with me. We had a bit of an entrepreneurial journey raising our first fund. We left our operating roles to start our investment firm on January 1st of 2020, and we thought that we had about 70, 80 million euros soft circled, And then on March 16th, when Emmanuel Macron announced we were going to be locked down, in the weeks following that, basically all the money we had soft circled disappeared, with the exception of two parties, a family office, that one of the largest family offices in France that continued to be there and supportive, and then thankfully for us, the French Sovereign Wealth Fund, which saw the real interest in having more health technology investors in France and in Europe. And I think a lot of my American friends, I'm from the States originally, think that it's crazy doing entrepreneurship in France. I think that there are a lot of strengths in Europe, and one of them is the presence of investors like the BPI and the European Investment Fund that are really supportive of emerging managers and structurally want our organizations and our firms to exist. So I think fundraising in private equity, venture capital, there are different kind of categories of investors, and like in a fundraise for an early stage medtech, people are curious who else is investing, who else is there, and as soon as you've been able to convert one investor in a particular category, so when you have your first fund of funds, then the other fund of funds will come and listen. When you have your first insurance company, then the other insurance companies are interested. When you have your first endowment, the other endowments are interested in being able to kind of talk about names by category helped. And we were very lucky, through persistence and hard work, we were able to build a pretty institutional set of investors in our Fund 1. But really, you kind of have to win each category one at a time. Not sure if that's also been your experiences.
Okay, good. And you all have very different geographic locations for your LPs. Are you starting to see a shift in mindsets and mentalities, considering the last 6 months have been challenging? It's probably the nicest way of describing it.
Last half years, so we're not on the market this year, so we'll plan our next fund next year, but this year I definitely talked with lots of my GP friends who are raising capital. It was tough because lots of the LP, especially institutional LP in the United States, they have lots of capital stuck in the public sector, and there's a percentage issue in terms of which vertical to deploy capital, so they basically couldn't deploy any capital in the private sector to the new fund manager. So that also pushed lots of the GPs start looking at, international LP, international capital, potentially joining on board. But on the other side, there's also a process of education need to be done to really, as other panelists mentioned, right? First, they need to understand the nature of a VC. Second, need to understand the nature of investing in healthcare. It's very different from investing consumer company or business model innovation company. So the expectation has to align before any capital join on board. So I think it takes time, but the good thing is with the whole trend of generative AI within healthcare, this afternoon I have another panel talk about large language model for healthcare. People start to looking at the healthcare industry as a very attractive industry, maybe one of the industry have the largest opportunity, leveraging AI to push for digital transformation. So I think more capital are looking at healthcare in a different perspective, and also bring opportunity for fund manager like us to start conversation with them. So I started lots of conversation with a newer institutional LP this year just to prepare for my next fundraise. During the conversation, I think the good thing is that they're super eager to learn new things, super eager to learn about new fund manager, emerging manager, and they also agree there's lots of momentum going on in the early stage investment, early stage startup, which is the opposite of the growth late stage investment. It just got limited by the current allocation strategy, and they're looking for potentially free up capital next year once the IPO market opened up in order to support more fund manager in the emerging side. So I do hope and I believe there will be more program focused on emerging manager, especially from institutional LP side, and it should be a much better environment for a fund manager like us to work with them.
Yeah, I mean, I think from like today compared to January, compared to summer of last year, it's gotten a lot better. I think a lot of the uncertainty that was in the market is now baked in. I think LPs have reshuffled their portfolios and are looking at new managers in a way that maybe they weren't a year ago. I know in the US, most of my fundraise has been with family offices, and in the US, a lot of them in the kind of the top of the market had shifted their focus a little bit more into direct investing. And as the market has turned, a lot of them are starting to back away from direct investing and are looking to redeploy some of those assets into fund managers instead. just because of how difficult it is to actually deploy capital and generate returns for early stage companies. The other thing that I think, I raised this whole fund during this cycle, and it's been an incredibly difficult process. But I would say that, like, as a first-time fund manager, it should be difficult, right? It should be really, really, really hard to raise a first-time fund, because it is a tremendous position of privilege in the market, right? And you are a steward for other people's capital. And I do think when money was cheaper, I think there was a little bit of this change in perception of people feeling like they'd earned or deserved a fund. And now we're kind of back in that cycle of, no, you really have to demonstrate that you are building something unique and differentiated and special in order to be able to raise capital. And it's much harder, but I think it is better long-term, both for those LPs, but also for the founders that are being supported.
I would say perhaps that, I fully agree with what you said, and I think it's clear that you have to look for a differentiating factor. This is becoming more and more complicated these days, obviously, because it's many of us, looking for money. Not us at this moment, but we will have to do it at some point. So that's obviously one way of trying to be different and to find for something niche, something different with a particular focus that has not been explored or whatever. And then, of course, the other way to have this success in fundraising is to show a strong track record, right? So there are some firms that they have managed to raise funds very quickly, and it was fund number 5, 6, whatever. And what I think is that this was because, first of all, the track record, and also because they managed during all the previous years in the previous funds to establish a solid relationship with the LPs, right? And as you said before, Lou, you have to identify or it was you, I don't remember who said it, but you have to identify some investors in every basket, and you have to establish a relationship with them that will last for many years. It's not only the life of the fund, but it's what you think that you will be doing later on, right? So I think that those are the two suggestions that if I had to give a suggestion to somebody, that's what I would say.
Mm-hmm. Okay, good. Samuel, something we discussed before this panel was around, and perhaps a good question for many of the CEOs here, is the dry powder left in the market and why we're not seeing it being allocated. I'm sure there's plenty of frustrated faces in here looking for capital. What's been the driving thoughts within your fund and the way you're allocating, whether you're thinking about putting money out into the market?
So I guess there's two parts of that. There's sort of the dry powder in the industry, and then what we're doing at Lauxera. So I think this is kind of a confusing time to be in the market as an entrepreneur raising capital, because on the one hand, I think there's never been more dry powder in venture world to in theory be deployed, but there's obviously been a major slowdown in terms of deal volume. And I think there are a number of drivers for that. I think one of the main drivers in the last 24 months has been a bit of a bid-ask spread difference between valuation expectations for companies and valuation in public markets and valuation expectations for investment committees in venture capital and private equity funds. But I think enough time has passed that bid-ask spread has narrowed quite a bit, especially in the last 6 months. I think one of the challenges that exists is I don't think it's obvious to people outside how bad the fundraising environment has been for venture and private equity in the last 24 months. So the equivalent of like the medtech investment bankers that we're used to talk to as medtech entrepreneurs in our world are placement agents. These are people that raise capital for private equity funds. I had one in my office about 6 months ago who told me, I've been raising money for private equity funds for 30 years. This is worse than 2001. This is worse than 2009. This is the worst I've ever seen it in my career. And so the impact that has is that no one is terribly motivated to go back to the market and raise the next fund in difficult market conditions. So you slow your deployment down because instead of being back in the market in 12 months, if I do fewer deals, I'm back in the market in 24 months when maybe things will be better. And so bizarrely, the sort of private equity fundraising environment has an impact on deployment, which then impacts the ecosystem of entrepreneurs raising capital. I do think that things are improving. I think, as always, it's driven by public markets. So, the S&P 500's like done pretty well this year. I didn't check it last night, but last I read, it was like up 16% this year. And I think that's helped relieve some of the pressure for institutional LPs that have this so-called denominator effect, which, private assets still are small for most asset managers compared to liquid assets. And as liquid asset prices decrease, and as the net asset value of the private assets sort of stays steady, at least temporarily, there's this issue of these LPs being overexposed to private assets. And when public asset prices do well, that relieves this so-called denominator effect, making it possible for them to reconsider investments in private assets. So public market valuations going up helps relieve fundraising pressure for private asset managers, which then basically makes people more willing to deploy capital. And at Lauxera, we've been very active. We've done now in the last 2 years, we've done 10 deals, 2.5 years. And we are going to go back to the market this fall to go raise fund 2.
Yep. And similar experiences for the others, or do you see other contributing factors to the reasons of the slowdown in investment?
I think one thing, especially at the early stages, is you look ahead to those future rounds and whether or not they're happening, right? And I think the Series B plus slowed to almost nothing for a period of time. I'm starting to see more Series A's happen, which is an indication that things are going to be picking up downstream. And one of the big risks, especially in healthcare and health tech as an early stage investor, is that there's a trough, right? Almost like a funding trough, where a founder gets that initial capital, they have to go build out their data set, and it is exceptionally difficult to raise capital inside that trough in a good market. It's even harder when the market is like this. And so I think one of the things that has I've seen people talk about is, do we believe that this founder has the ability and has access to capital to raise through that trough? Because founders just have fewer opportunities to get extensions. They have fewer opportunities to have a redo on their go-to-market. And so what that means at the earliest stages for founders is that everything just needs to be a little bit tighter. You have to have a much better sense of what you're building. You have to have a lot more validation and traction than you maybe had before. And one of the big things that I tell founders that I work with is not all traction is created equal. The traction has to be in line with the business that you say you're going to build. Mm-hmm. And that's something that I think before you were able to get away with a little bit. And now it's tightened up a lot more on the diligence side.
Yeah.
One final question for the panel before I open up to the audience. ESG has been a topic that gets talked about a lot. What's the reality when it comes to your LPs, and is it something they are looking at, and are there particular areas of impact that they find pressure points on?
Yeah, so for ESG has been a super popular topic among LP community for the past couple of years. But I think in general, I think it's not only LP, both LP or GP are still figuring out what is the most practical way to integrate that concept with the really financial-driven venture investment. Because all of us, I think I can speak for other panelists, is we're prioritize financial return for our investment. That's number one. And meanwhile, of course, we want to encourage the company and support the founder be able to provide a solution, also fulfill ESG target in a certain way. So we're trying to find the best way to balance both of that, and also meanwhile to really help founder understand how to be smart in terms of doing the right thing in a smart way. Going back to the LP side, I think they're also trying to figure out whether just to purely allocate capital to a ESG focus as an impact investment, and only look at other different metrics like how many people got jobs and carbon credit, etc., versus still coming back for the existing financial-driven VC firm, how to have another layer on top of that to implement ESG. So we have lots of discussion with the LP. I think things are definitely getting better and more clear. And for example, I was talking with one LP recently about digital biology. Digital biology is supposed to be, healthcare investment, but one subsector is the synthetic biology. Synthetic biology could also apply to chemical industry, help them, in terms of innovate the process of chemical processing and eventually benefit for the environment. So that's a perfect example that essentially this is creating a huge market opportunity and also applying a new technology, but also is complying with the ESG guidance. So I think this type of vertical is become more and more popular. Of course, there's also other sector, probably we have to sacrifice, investor had to sacrifice financial return a little bit in order to achieve the ESG goal, but also there's more and more vertical that we don't need to do any sacrifice. We could achieve the goal at the same time, and also especially leveraging the new digital tool to help us effectively achieve that goal. So at least that's what my understanding about the ESG. Still going back, essentially we're a financial-driven investor. Financial return, DPI, is the first priority for me in order to responsible for the LP I'm working with. But meanwhile, having this ESG mindset as one of the criteria really help us back the best founder and big potential startups.
Yeah, the reason why LPs invest their money put their money with us is to drive returns, right? Yeah. Fundamentally. Most of my LPs also have other philanthropic endeavors that they're interested in. But the mindset is that the money that goes into my fund is something that's going to be able to help fund those endeavors in 10, 15, 20 years down the road, right? That's the way that they're thinking about how to use their capital. And so, a lot of those folks have just different pots of money for things that are tied to the causes that they are most interested in. That being said, one of the things that I really like about healthcare as a space is that there is a way to overlap doing well with doing good in a really interesting way. So, for example, with our fund, one of our big focus areas are companies that are addressing some of the root causes of lack of access to care for underserved populations. And the belief is that, about 70% of Americans actually have pretty crappy access to healthcare in the US, right? So being able to solve the problem for those large segments of the population is something that can drive returns just because of how large that market opportunity is. But there's no mandate on the fund. That just happens to be where I think there's opportunity for us to deploy capital.
I think that the ESG and the impact is something that, it's here to stay. That's for sure. We are not fundraising now, so we have not tested the waters with the potential LPs on which is their perception of that. But I'm pretty sure, because I know from other colleagues that it's very important for them. Of course, it's not going to be more important than making a financial return. That's for sure as well. But the good thing that we have investing in life sciences is that we have an impact per se, right? None of our funds is an impact fund, none of them. But we have started monitoring some time ago all the impact that our portfolio companies are doing and what our fund is helping to do in terms of impact. And we were really positively surprised, right? And we have developed our own methodology, and we have realized that investing in this sector per se has an impact, independently of being an impact fund or not. And I think that that's something we have to clearly transmit to LPs, because I know that many are asking, okay, are you going to be an impact fund? And then we can say, no, it's not our intention, but here is the impact that we are having and our portfolio companies are having, right? So I think that that's something that we have to convey to LPs. And in my case, I might be biased, of course, but I really think that putting private money into VC firms that are focused on improving the life of patients and these type of things is much better than doing in other sectors, right? That's my humble opinion.
Good. Well, look, thank you very much for your time. Appreciate everyone listening. Thank you to the panelists, and enjoy the rest of the conference.
Thank you.
Thank you.